I mean, the yield companies had a very good year last year, 2022, relative. I think we are seeing that bit of rotation. AI story really gripped the market. That's what changed the narrative in Q1, really. And we've seen some upgrades from the tech companies. We've not seen how that plays out for the rest of the economy. But I think the key thing to focus on here is not just the winners of AI. We're very much focused on trying to find companies that are going to be disrupted, because it's as important to understand those companies and ensure you don't have those in your portfolio as much as to understand who the winners of the AI.
So in lieu of our next little chat, I've actually done a bit of work on a couple of full year results, and you and I were talking about this off camera. So Land Securities, currently the shares before today, I think 574. Now Land Securities, there you go, they're on the screen. What are they trading at there? Well, down 7% this year, but they're trading roughly 574 as of last night's close. Land Securities believes it's got an EPR NTA, which is a net tangible asset, of 936 pence. So they think they are massively undervalued in terms of a share price performance, trading at 577 as opposed to 936. British Land, if we can chuck that one up as well, did a bit of work on this one. They are currently trading, as of last night's close on Friday, 303, currently trading 305, mild pop there. They believe that their EPRA net tangible asset is 588 as opposed to 305. So some huge disparities, despite the fact they've marked down the value of their portfolios. Disparities between what the market's valuing that and what they believe their valuation is. Now, the reason I mention this is because you said you've seen real weakness in real assets and infrastructure markets, absolutely, unarguable, as investors have sold out in recent months upon recession fears. Yet, and this is where I think it's interesting, Newton, see it as a good opportunity to rebuild these positions as people start worrying about deflation in the short term. So I've laid out my case. You know what I'm saying. They have marked down their valuations quite aggressively in the case of British Land. I think I've got the actual number, by 19.5% in the last year, and down aggressively over Land Securities. But the market thinks these valuations of their assets is nowhere near enough.
The market's much more excited about the tech story. I mean, that's the reality of it. And I think this is the opportunity for investors as we see inflation numbers start to come back down again and people start to worry more about deflation than inflation, particularly in the UK towards the back end of this year as we annualise, I guess, the sell-off in sterling due to the LDI crisis in September, October last year. You know, sterling bottomed out at 105, we're at 125 or so today. That should mean that imports start to abate, the cost of imports, so that should be a deflationary impetus, at least on the year-on-year basis. And that will be the opportunity, because in the longer term, we continue to see that inflation will be at an elevated level relative to what we've been used to over the last 20 years.
I see challenges, whether it be on prime office, whether it be on mixed estates, whether it be on retail, and whether it be on warehousing, which was supposed to save this sector as well. I can construct a concerning outlook for all three parts of the portfolio, given the longevity of higher rates in the UK and elsewhere as well on a global basis. I have my concerns that the revaluation hasn't gone as far as it could.
In real estate, I think that's true. When we look at real assets, we have a lot of companies that have fixed inflation-linked revenue streams.
Right.
So things like renewables, Greencoat UK Wind, some of those companies where you have government-backed revenue streams, power prices that are less sensitive to the economic cycle. Mm-hmm. I think when vacancies are very high, you've got to also look at the leverage on the balance sheet of real estate companies, because when you get those devaluations, all of a sudden your leverage is much higher than you expected it to be. Particularly in the US market, where we see huge vacancy rates as people just haven't come back to the cities. And I think this is some of the focus we're seeing from large corporates that are trying to get people back to work. Mm-hmm. I think there's a lot more pressure behind the scenes of governments trying to get companies to get people to come back to the office to ensure that we don't have these huge problems with these significant real estate books. But companies, you know, the REIT sector, it does get priced into the market. Where it doesn't get priced in so quickly is in the private markets, where those NAVs are much slower to react. And I think if you're in an open or closed-ended fund that is daily traded, the opportunity, of course, is to sell some of those where you can get cash at NAV back and look for other areas where perhaps the market's discounting it much more heavily. Yeah.